Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. It's the second anniversary of the launch of the Spider Gold Mini Shares, ticker GLDM, and George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors, joins me to discuss why now is a good time for advisors to increase their strategic allocation to gold ETFs, like widely traded GLD and GLDM. George, it's great to have you with us. Welcome back to Trade Talks.
Well, thanks for inviting me, Jill. It's good to be with you.
And it's the second anniversary of the launch of the Gold Mini Shares, GLDM. Why did State Street bring this kind of product to market?
It was done in partnership with the World Gold Council, just like GLD was. They're the sponsor of both of these. We're the marketing agent. And it's been a really, really good teamwork ever since, more than 15 years ago when we launched GLD. But I think the deal is we were conscious 3 or 4 years ago that there was a growing trend across the whole universe of ETFs, not just gold ETFs, toward lower share prices and lower expense ratios, with obviously a real focus on costs. And we wanted to make a gold product in the Spider family available to investors that met those kind of needs. And GLDM was the logical conclusion there. What I'm intrigued in is to see that that in just exactly 2 years to the day of its life, it's already amassed almost $2.5 billion in assets under management. It's up more than $1 billion in the year to date. It's established itself as easily the market leader in that space of low expense ratio ETFs. There's a plethora of them. It's almost become an overcrowded market, but GLD Mini has established itself as the market leader in that space. And in terms of all of the gold ETFs in the US, it's already at number 3. So I think that's really pretty good going in just 2 years. And at number 3, it's behind 2 products that have been on the market for more than 15 years, one of them being GLD. So it's done pretty well.
Yeah, I mean, clearly there's demand there for the product. So it appears it hasn't taken away any market share from GLD or a portion of it?
No, my sense is it's not. I think it's taken market share away from the competition, if we want to call it that. In the 3 years before we brought GLDM to market, GLD was accounting for just over half, about 53% of total inflows into gold-backed ETFs in the US at that point. Since we've launched GLDM just 2 years ago, we're now up to something like, we're above 60% with the 2 products combined. So the 2 products have grown together. GLD is up $15 billion. GLDM, as I say, up over $1 billion year to date. The 2 products have grown together side by side, which to me is a clear demonstration there's a need for both of them. There are investors who want the low expense ratio and want the share price based on 1/100th of an ounce of gold rather than 1/10 like GLD, which means GLDM is a $17 share today. GLD is a $170 share. And with the expense ratio at 18 basis points, GLDM is on a par with all of the rest of the low expense ratios. Some of them are half a basis point lower, but it's on a par with the very, very lowest expense ratios available in the gold space out there. So as I say, a clear leader in that space, and number 3 overall is pretty good going.
What tailwinds and headwinds do you see impacting the price of gold moving forward?
Not an awful lot of headwinds right now. I mean, if there is a headwind, it's the fact that we're already up well over $200 year to date, and it's going to be interesting to see just how much further we can pass. We are still, I think, in an upward phase. Just 2 or 3 days ago, we closed at the high for the year, so setting a fresh closing high for the year, and I think there's a good deal of further growth to come. I think that all of the things people were worried about last year in the pre-corona era, if you can remember that far back, all of the things people were worried about then, like potential for a downturn in the stock market after 11 straight years of gains, the possibility of a recession after the first decade in the history of the US that didn't feature a recession. Well, we're in one now, no question about that. People were worried about, people worried about the outlook for equities and not finding a lot of comfort in fixed income, where there are 0 interest rates for the foreseeable future, the Fed promising to do whatever it takes for as long as it takes. I think that we're in a very much a historically low interest rate environment, so there's no great comfort in the fixed income market either. And I think that that gold is really fulfilling its purpose right now, and I think that's what's going to continue to drive the price.
So even with the highs it's been making, do you think it's still a good time for advisors to increase their allocation to the gold ETFs, whether it's GLD or the gold mini?
Yeah, I think, I don't think investors have missed the boat in 2020 at all at this level. There's a lot of people suggesting the price could easily see $2,000 by year end. That may be a bit rich, but I'm not going to rule it out. If I were putting together a bullish scenario for gold right now, I try to do bear, base, and bull cases on a regular basis. If I were putting together a bullish scenario, then $2,000 would probably be the price that I would go for. And I have seen some suggestions of an 18-month target of $3,000. That may be a little rich, but we'll just have to see. Gold has surprised me many times in all the years that I've been involved in it, and I'm quite capable of being surprised again. And if we do get surprises, Jill, I'm confident they're going to be to the upside in 2020.
All right, George, great to catch up with you as always. Thanks for joining me on Trade Talks.
Jill, thanks for inviting me. It was great to be with you.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.